So the answer is, though, very easy because you have a stop loss based upon the current ATR at entry and your AUM, and you're going to risk a small percentage. My first year of trading was pretty poor, and it was just all based on not following the rules, lack of discipline. Well, I think the right thing to do is to definitely have multiple trend following systems, different parameters, shorter term, longer term, and then allocate the capital 50% to each, 25% to each, 4 systems if it's 4 or more.
Hello, everyone, and welcome. It's good to have you with us here on the Trend and Turtle podcast. I'm Ben Lichtenstein here with Jerry Parker, a.k.a. one of the original turtle traders. He started trading back in the early 1980s. Jerry's been trend following for 40-plus years. He's the chairman and chief executive officer of Chesapeake Capital and Chesapeake Holding Company. JP, good to have you back.
Hey, Ben, good to see you too. Looking forward to our time together.
Big time, me too. Just a real quick reminder for everyone out there before we get started. This podcast is intended for educational and informational purposes only and should not be considered investment or trading advice. Trading involves substantial risk, and past performance is not indicative of future results. Jerry, I'm excited about today's show. We're going to pick up right where we left off because last time we were together, you said something that deserves a lot more attention than it got, something that really stuck with me over the last few weeks. You said the time to do the right thing is now. We were talking about systems, talking about identifying flaws or weaknesses in one's trading strategy, and when should you correct them once you've identified them? And you said, right now, immediately, you said. You said it's hard enough to figure out the right thing to do, but when you know something's right and you still don't do it, you said that's foreign to me. It's such a simple thought, but Jerry, very powerful in many ways.
But I think I've done that before. I'm just talking to myself really like, Jerry, the time to do the right thing is now. And so you have to coach yourself up sometimes to get your confidence back. One of Richard Dennis's favorite statements was, do the hard thing, do the right thing. And I think, and then I posted something on my Twitter recently that's a little bit different. I can't really remember it. Let me see. It is, choose the hard right over the easy wrong. I like that. A little bit different, but I think that's the way trading kind of works, especially classic systematic trend following. These rules and these trades don't always feel good. They're not meeting our psychological needs.
Yeah, they're simple thoughts, but they're really profound thoughts, and I feel like these are these kinds of ideas, these thoughts that transcend trading in so many ways. They cross over into that life in general kind of aspect or idea. I mean, it makes me think about conversations I've had with my sister, for example. She'll listen to our podcast and then she talks to me and she's like, look, I'm not into the trading aspect really at all, but I love it because it all kind of fits into these little life lessons and sort of these ideas that you can apply across different areas of just your everyday experiences. So, and we've all had those moments where, deep down, we know what needs to be done, but we hesitate for whatever reason out of fear, comfort, right? Routine. It keeps us from doing it. But that's something that we hear a lot about in terms of trading, how trading struggles are often reflections of personal struggles. And for me, what's really appealing to this is that strict, systematic, that rules-based approach. It helps with kind of removing that discretionary struggle or the ups and downs associated with discretionary trading. But again, as you're saying, it doesn't eliminate the struggles because we've talked about this before. Most of the time, this approach isn't easy. It's not comfortable or pleasurable, but that's also, I feel like, how we know that we're on the right track.
I think so. I think taking the small losses and letting winners run, it's really difficult in practice in the real world to do those things. So it's just what works. And so let's don't be surprised that, like almost every area of life, it's what works is a narrow path. And what usually works is not what makes us feel good and happy. But that's maybe the reason it'll continue to work. Very few people will be attracted to it. Let's hope so.
So last time we were together, you said something else that really stuck with me. We were talking about, or I was saying that I was starting to really see the connectivity, the continuity with the classic trend following system approach, talking about treating every trade the same. We were talking about trading every signal, right? Following the rules on entries, following the rules on exits. I started thinking about it kind of almost like this piece of fabric, right? I was talking about how each principle, each rule is kind of like this component, this piece of the fabric, these individual threads, I guess is the best way of putting it, kind of woven together. And together, they do create this structure, this strength, this fabric, this protection, but almost like a blanket. And yet, even after seeing all that, I was still fully hesitant. I was hesitant to fully begin. Last time that we were together, you said, and it wasn't necessarily specifically directed at me. I can't even remember exactly what we were talking about, but Jerry, you said something. You said, wait a second. You said, and I think you were talking in general about traders. You said, wait a second. You came to me. You said you wish you could figure out the best way to trade. Okay. Now we've given you the framework. You said you'd be happy if you knew how to do it. Now you know how to do it, but you're not happy because it's not what you anticipated. And honestly, Jerry, that hit me really hard because I think a lot of people assume that the answer, if they ever find it, it's supposed to be a system, a strategy, it's supposed to be comfortable, like we've been talking about, right? But trend following, systematic trading, a lot of the time, again, feels more uncomfortable and as you were just saying, uncomfortable by design in many ways.
I definitely didn't say that about you. I've said that, I've seen that over the years with friends and colleagues that, they knew how to trade. They were just trying to improve upon it. Like, how do I get rid of the drawdowns? Or how can I win on, instead of 40% of the trades, how can I win on 50-some% of the trades? So they had the magic formula. They had a great mentor. They were ready. They're so thankful. But then it wasn't good enough. It made money. It did have some drawdowns and bad periods. It was waiting for the big winners, which was not 5 to 10% of the trades, and then 60% of the trades will be losers. A very small percentage will be very big winners. Still was not good enough. They needed the money and the knowledge and the success plus I wish it was done another way. I mean, I could not sympathize with them and do something else. If you don't like trading, if you need trading to fit your personality, maybe you're not cut out for trading. So, but I definitely did not say that about you.
Well, no, that I kind of took it as a little bit of a kick in the butt. I in some ways took it personally or definitely had a personal application that I could, had with that. And, I sometimes feel like a broken record when I constantly reference that the article or the comment, I should say, the comment that Richard Dennis originally made about how he could post a system, his rules in the paper and nobody would follow him, because I kind of feel like that kind of feeds back into it again. It's like you have these, you see the right way to do it, but yet it's not what you expected it to be. And so you don't follow them.
That's right. That's still rampant today, that if you gave someone the rules, some good rules, they would not want to follow them because they would want to maybe add some of their own stuff to it, even though it didn't have any evidence that it actually worked. Because once again, you want to have it both ways. You want the success, and it should be pretty easy and comfortable. So that's why I think if you started out trading and you were researching and you said, 40% winning trades is what I've heard people say, I'm going to go for 25%. I'm going to make it even worse. If giving back profits is a problem, I'm going to trade so long term, but I'm giving back profits bigger than anyone else is giving back profits. Then you're probably on the right track. You could probably overdo it as well, but pursue pain in trading and doing things that a normal person in your own logic would say, hopefully it doesn't work this way, but it does, and you need to embrace it.
Yeah, that's an interesting thought in some ways, that at some point there's probably is a diminishing returns, right, in terms of embracing that discomfort and that unease.
Yes. Can't be a martyr or masochist.
Can't push it too far.
Yeah.
So for me, Jerry, what was very personal about that was it made me think back to this quote that I used to post in the chat room back in the day for traders. And I actually thought it was Goethe, but I looked it up, and it's W.H. Murray. I think it's from the Scottish Himalayan expedition. And the quote is, bear with me here. It says, until one's committed, there's hesitancy, the chance to draw back. And I'm kind of paraphrasing as I quote it here. There's one elementary truth. It says, the moment one definitely commits oneself, all sorts of things occur that help one that would otherwise have never occurred. A whole stream of events issues from the decision, raising in one's favor all manner of incidents and meetings and material assistance, which no man would have believed would have come his way. So basically, once you commit, kind of the stars align and things start to happen that you couldn't imagine happening, but they do, because again, just that drive and that commitment and that vision.
It's so how are you going to commit, though? How are you going to commit? What is it going to take for you to truly commit? That's the issue. And it could just take some losses and some really regrets and looking around and seeing how much money you should have made and how successful you could have been. And some people don't need that, and they just start off great from day one. But a lot of us need a lot of evidence that doing it our way is not going to work. And I was there. My first year of trading was pretty poor. And it was just all based on not following the rules, lack of discipline. But then when I interviewed for the job, I was telling my interviewer, yeah, I mean, I'm so disciplined. I'm going to be disciplined. Yeah, because I had read that's what you need to be. But until you get on the firing line, it takes practice too. I think practice is a good word, because a lot of things like this just take practice. You need to practice controlling yourself and your emotions and relying upon the rules. But it can take some people forever, and it's some people quickly, and some people never can get it. It's not a human flaw. It's just you're not meant to be a part of this type of trading, I guess.
So as I've been cycling through this fixed basket of products, the stocks, the ETFs that I've been trading, started noticing a couple things, and I wanted to pick your brain on a couple things. First, the idea of buying strength. Okay, so you get the breakout, and as far as I remember, and we've talked about this a little bit before, but I just kind of want to drive the point home and sort of solidify it. But so the idea of buying into strength, the market breaks out, makes a new high, for example, on a Monday. And my understanding as a turtle, you guys bought that breakout, the actual tick above the that price line. But nowadays it's a little bit more. Correct me if I'm wrong, but there's a little bit more of a passive approach to it, right? So, for example, you're waiting for a close that's a breakout, and then the next day you buy on the open or throughout the day. In a consistent fashion each time. Then the other idea is, even if you distance yourself further, like we were talking by email about that friend of yours who he's looking at his trades at the end of the week, right? For example, and he's trading the next week based on where products are closed the week before.
Yeah, I think all of those are valid approaches. Especially if it's long-term trend following, and your average holding period might be 9 months to 12 months. No magic formula for getting in a little before the breakout intraday. That's the way we did it for a long time. Then we went to doing it on the close or the next day's open.
Mm-hmm.
So it's no magic. It's nothing. It's more of an operational thing. Whatever you can get your computer set up to monitor the breakouts and produce the trades. How many are you doing? Do you have traders? You got to do it all yourself. It's just what's the best way to most organized way to get these trades on and get them off and not miss signals through a lack of carelessness or being overwhelmed by too many markets. I like to trade a lot of markets, so it puts a lot of pressure on the infrastructure. And one way to relieve it is say, okay, we're going to trade a lot of markets, hundreds of markets. Let's have the computer tell us what we're going to do tomorrow based on the close, and we'll get it done on the open or throughout the day, as you said. So it's nothing magical there about, there's all kinds of things that we won't get into about how to execute. And well, we could get into it later, I guess. What's the best way to do trading? But as far as when to do the trading, it's all pretty much created equal. We tested it out. It's probably not a lot of difference. Yeah, but certainly in a bad period, like a year ago, April, and when was another bad period? COVID. Yeah, those two periods stand out for me, where waiting for the close just seems like an eternity.
Mm-hmm.
And in those situations, it would have probably been a lot better to trade throughout the day. The low has been made. Let's get out of this thing. Because the next thing you know, it's now 2 or 3 ATRs below that. And we're still waiting for tomorrow's open. What? And so that pressure. But, if you looked at it over time in a back test and you took the good and the bad, I'm just focusing on the bad now, it would probably come out to about the same. Neither strategy would be superior, too much superior, to where you would want to make a change. But definitely trading intraday feels a lot safer. So does that make sense? Do you understand?
Yeah, perfectly.
Yeah.
And it's funny because you said, I thought you were going to answer yourself when you said when to do the trading. Basically, as you said that, the thought that came to mind is you do the trading when it breaks out, when the system tells you to do the trading, right? But then again, we're getting a little bit more kind of in the weeds and getting a little bit more into the details in terms of exactly, time frame wise, when do you put that trade on? But my understanding, again, is what I'm hearing you say is there's nothing necessarily that's going to work better than one. They're all going to kind of perform about the same over time, as you say, but it's the consistency, right? You don't necessarily want to do it one way, one day or 1 month or 1 year, and then the next day do it a different way, right? If you commit to doing it one way, whether you're, waiting for the next morning to get into a trade that broke out the day before, that's the way that you should be doing it every single time. Or if you get in on the close of the day of the breakout. But each trade, again, you do it the same way consistently.
I agree with that 90-some% of the time. I would throw in, though, that I could envision a situation where maybe you're trading a little too large. Your system's not as good as it needs to be. You've suffered a lot of losses recently, and you're really facing a critical period. And on top of all your bad luck over the past year, now you have tariffs or the COVID situation. And you're like, I'm really getting to a situation where this drawdown could be fatal. And so I would not just sort of sit there and say, well, I'm not going to do anything because I've
been doing it the same way every single time.
Yes.
Right,
and so you got to have that mentality of staying in the game, preserving your capital. You've already violated so many rules that would help you in that area, possibly. But I would never tell anyone just to sit there.
Sit there in a hurricane and say, hey, it's just a storm.
Yes, let's go inside. Well, we never go inside, and it's never hurt us before. Well, we've never seen a cocoa trade like that before, and it happened. And so good things can happen, bad things can happen that we've never seen before. And that's really what trend following is all about. Where history's fun, and history can repeat itself, I guess. But sometimes things happen we've never seen before. And in this systematic approach, we're equipped, we're ready. Most of the time. Be kind of ready. And better than most any other methodology, because all we're doing is saying, hey, I'm not sure what's happening here. There's nothing in the news, but here's a new breakout. I'm going to take it. And then we find out later, that was a good call because somebody knew some fundamentals that were pushing the market. And just by following price, we latched on to the smartest people in the market, even though we didn't know what they knew.
Yeah, almost like participating in the unexpectedness, the unexpected, just again because price tells you to and system says to in a consistent fashion on a regular basis every single time. So then that brings me to another question, Jerry. So, okay. So the idea is you have this risk associated with the ATR. And is there a bone to pick, or is there a hair to split in terms of the idea that that initial risk, that initial hard stop loss, based on the assets under management, based on the ATR and your risk per trade, but is that ATR, is there anything, again, is there a hair to split in terms of where that ATR needs to be placed? I mean, obviously it's relative to your entry, but what if your entry, for example, was, again, kind of what we were just talking about, what if your entry was on the close yesterday versus on the open today? Your ATR, your risk, your stop is going to be, could be at a fairly different place.
Right. So I think it's probably better to use the actual fill price. But I would adjust my computer, given your example, to tell me that the entry is going to be on the open, if that's where I'm going to do the trade. But I guess in hindsight, you sort of get a signal, and then if you're trading on the open, not intraday, that's kind of a goofy situation. But I guess the bottom line is I would just use my fill price. You're using the system to force yourself to do the same thing on every trade all the time in the same way. And that's all it's about.
It's not necessarily that the system's magical. What's magical is the consistency and the approach.
Yes.
Yeah.
Exactly.
Yeah, that's so interesting. That's, again, kind of gets me back to some of the things that we've talked about before, how, you say, hey, well, one is not necessarily better than the other, they're both good, or when we talked about baskets of products, for example, and stuff like that. Okay. So
within reason, I think.
Within reason, understood.
Within reason of the trend following strategy.
Yeah.
But it's what a machine would do. We have this sort of unsophisticated machine. It does something for us every day. It's not the best machine, but but the only way the machine works is by doing the same thing all the time. And that's the definition of it working. So that's what we have to do with this approach. We need to improve it possibly, but it's not failing if you're the only person of all your friends who liquidated a trade and as soon as you get out, it went right back to the highs. Your system isn't broken. You'll win the next one, and they will lose possibly the next one. But so it's doing the right things. It's tested out well. That's where your confidence should come from. It's all about the back test, really. Yeah, it's all about the back test and being and that's what should give you confidence. I've come out of so many research meetings over the past 30, 40 years, and I've just been sky high, like, this is amazing. It usually doesn't really pan out that way. It's not as great as it looks from the computer, but still, there's no replacing it. You should have tons of confidence in your strategy if it's done right, not over-optimized, not curve-fitted. But that's where you got to dig down deep when you're losing money and say, hey, we tested this. And I told you once before, we had a really, really bad period. I think it was that Volmageddon. And it was just like crazy how bad it was and how much money we had lost so quickly years ago. And I'm on the front line and I'm dealing with this. And there's people who help me in computers and research and writing code. They're not on the front line. So they're more relaxed, let's say. But they were getting shaken as well. And one of them came into my office and I was like, what should we do? And he goes, well, it just depends on if you still trust these systems. I was like, yeah, you're right. It does. And that guy still works for me. And I bring this up to him a lot because he kind of settled me down because, that's right. It's the basics. The basics. There's no magical words here. Do we still believe? Did something crazy happen that affected everyone and probably lots of people lost money regardless of how talented they were? We're going to single ourselves out and want some sympathy and act like we should radically change our methodology. One of the best ways to change your methodology if you're unhappy with the markets is to trade smaller, not change your system, but trade smaller. And that's not usually the first thing on people's minds.
Okay, that brings me to another thought situation. Again, with the trading smaller thought in mind, I'd imagine if you're trading, hundreds and thousands of shares, then this isn't as big of a deal, obviously. But if you're trading 3, for example, or 5, and you have 2 separate systems that you're trading, in theory, you'd like to allocate equally to both. But is it just kind of one of those situations we were talking about before, for example, where it's like you just consistently do the exact same thing every single time? Because at some point you're going to have to make a decision. Do I allocate the bulk share of this, uneven amount to one strategy or the other?
Well, I think the right thing to do is to definitely have multiple trend following systems, different parameters, shorter term, longer term, and then allocate the capital 50% to each, 25% to each, 4 systems, if it's 4 or more. And you are doing the same thing for, you are following each 2 different systems. So there's no problem there. Your robustness of your strategy and is still there. It's just you're trading 2 different strategies that are very robust, and you should, that's not a violation, I don't think, of any. It's not an inconsistent approach.
All right, let's see. Okay, let's talk a little bit about, this is another example, Jerry, that I've not really struggled with, I guess isn't the word I would use, but it's something I've thought a lot about. So for example, we've talked about this before, you've got gold, which has been in an uptrend now for, I can't remember, I looked at the chart, I think the breakout was January a couple years ago. And you've got a situation where it's been in a bit of a range right now, back around this 4,500 level or off the all-time highs, kind of just chopping sideways with all this, unease, uncertainty in the news that just doesn't really seem to be driving price one way or the other right now. But the idea being that the next breakout is not necessarily a breakout to buy at this point, because the breakout to buy, again, was 2 years ago. So now you're positioning yourself almost I feel like you're at a disadvantage in terms of, obviously the trend could continue, gold could go to 10,000, nobody knows. But it feels like it feels like it's a little bit long in the tooth at this point. So how would you approach that?
Well, I think it depends on why you missed the gold trade to begin with. If you weren't trading gold at all, you just started trading, that's just a nuanced approach. How are you going to work on that? If you miss gold entirely, that's just, you probably, maybe the action is going to be the same. You probably want to get in at some point, maybe at the highs, or you're going to size it with the current ATR. It's a mess. It's really no perfect answer. It reminds me of watching CNN when a small plane crashed and they brought on the pilots to comment. This famous person crashed his plane, died. And they said, okay, you're a pilot, you're an experienced pilot. What do they tell you to get out of situations like this? And he said, well, they tell you not to get into situations like this. So you didn't get, what can I do? I told you, you knew what to do. You didn't do it. All the other solutions are going to be not as great. We're not, gold's in a breakout. Gold's in an uptrend. My system says to get in. I should be long. No, gold. Your system said you should buy the breakout 2 years ago. Now it's a mess. So the answer is, though, very easy, because you have a stop loss based upon the current ATR at entry and your AUM, and you're going to risk a small percentage, and in the hopes that, like you said, gold can go to 10,000. So it's really not a good answer, because now if you're managing lots of money and you bought gold 2 years ago, and then you get some more money to manage, you get those clients in line with the gold trade as if they bought it 2 years ago, because they're going to get that same performance that all your other clients are going to get in the future. So that's kind of in the weeds way of, for a manager, if you're managing money, you've got to get everybody in line and true up the position based upon the increased assets. But there's no great answer for a non-system trade. How do you make this trade great? It's not a system trade.
Mm-hmm.
And we're not trend followers. Like our highest calling is not to be a trend follower. It's to be a system trader. And so if you want to describe what we do to your friends and family, you're probably going to use words like trend, momentum, trend following. But really, we're basically following those systems, and it made it. And gold looks, like you said, it looks like it's not going to go up. All these words you put around it. I forgot the one phrase I wanted to comment on that you mentioned. It's tired or whatever. Mm-hmm. These are things
range bound, I said, or sideways choppy type trade, or
So these are things we could talk about in a cocktail party, but really, it's not going to impact our trading because you're not. You've heard of this thing in sports, the eye test. The eye test. That team doesn't look that good. They don't pass the eye test. Yeah. As soon as you start looking at your charts in the markets in terms of some sort of subjective eye test, you're going to miss a lot of good trends. You did a back test. The system looked at thousands of trades. A lot of those trades look just like gold. And what does the system tell you to do? Stay in there, follow the rules. Don't pay attention that gold is kind of not going anywhere. It looks really tired. And that's sort of the bottom line to gold. But I've missed a lot of trades and been facing this exact same situation. Now that I've screwed up, what do I do now? There's no really great answer.
I think in the example that we talked about in terms of my specific approach trading this basket of products, for example, like GLD, it's where I have to just be patient and I have to wait for the next move. Okay, here's another kind of interesting example that I noticed. I think it was IBM. So you have a situation where a trade gets triggered. I think it was a couple months ago. And as far as I remember, short-sided, a breakout to the downside. I could be wrong about which way it is, but let's just say you have a short-side trade that gets triggered, and the trade pulls back a little bit, but it never gets stopped out. So your ATR, initial hard stop, never gets triggered. And now the trade has kind of come back over. So if you had missed that trade, and you now have an opportunity to take the trade that you missed months ago, is that a situation where you would say, okay, I'm going to get in this trade?
I think that I'm just curious as to why you missed this trade. But
well, again, like for me, for example, starting out strategy on day one, let's say that, say it's starting May 1st, but if this trade had triggered in February, I wasn't even trading the strategy back then. So now there's an opportunity where it pulled back a little bit away from the trigger, but it never got stopped out. And now it's right back to that trigger to the point where, again, it's an opportunity to almost roll back the clock.
Right. I think another thing that is worth mentioning, and maybe this isn't the exact example, but maybe I would have a big question of, do I get back in at the initial breakout level, even though the market has went a lot lower or went lower, a few ATRs lower. Now, do I wait for the all-time low, of this recent trade, or do I go back and look and say, 2 months ago it got in at X. I'm going to sell X, even though it's not the recent low. So I think it's probably always better just to sell the recent low. So don't try to redo the trade and say, I got lucky. I would say, wait until that low. I don't really know why I feel that way. I know that that's the way we were taught but I just don't remember Rich's reasoning behind that. And so maybe that was your question, but I would definitely wait until the low or the high is hit. Like in gold is another example. Gold's way off the high. So I would probably get back in at the highs. And it's just so horrible, isn't it? So maybe that's the reason it's correct. God, so painful. I would like to get in now. I know it's probably going to go to 10,000, but I'd like to get 4,000 to 5,000, get that $1,000 in as well. And so buying now, so probably the hard thing to do is to wait until a new signal. So it's not a system trade. We've totally blown it for some reason. Not our fault, like you said, but, you're going to have, in that particular startup situation or something like that, you're going to have some system trades where you nailed it totally like you should have, and then through some other circumstances beyond your control, possibly, you have to just wing it on those. Does that sound right?
Yeah, no, it does. And as you say it, I'm kind of thinking in the longer term, I mean, that's maybe not the biggest worry at all either.
Exactly.
I mean, when you're talking about just a few trades on the bigger picture.
Yeah.
As you get started, right?
Another way to do it is 50%, 50-50. I'll do some today. I'll do some at the low. Especially in something like gold that's so far off its highs. I don't know. Make these small little decisions and just realize also that embrace the idea that it's a small loss. Why am I even thinking about this? Beyond just put a little bit of thought into it, and then I'm just going to go and realize that this may not work out for me. But once again, you're going to be consistent. I consistently wait for the highs or the lows. I consistently do 50-50, or I consistently just get right in here with the system. And as if, I'm getting new assets under management, and I would just do, if my assets doubled, I would double the positions today. Even though all these new clients, they're not really they didn't get in gold 2 years ago. They just got in today. So I think, like you said, just be consistent. That's the big takeaway. Always do the same thing. And if you want to change your mind later, that's okay. Change your mind and then start doing that. Just don't keep flip-flopping.
Hey everyone, thanks for joining. Before we sign off, just a quick reminder, today's podcast was intended for educational purposes only and should not be considered investment advice.